Chairman Hall, we're ready to begin when you are.
Thank you, Ashley. Good morning. This meeting of the board is a hybrid physical virtual meeting. I'd like to welcome those in the boardroom with me today. While keeping your microphone muted, please join me in the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic which stands one nation under God, indivisible, with liberty and justice for all.
This time, I will ask the secretary to the board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting. Chairman Hall and Board Member Smith. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have two OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Hall, that concludes the technical and protocol items. We're ready to continue when you are.
Secretary will now read an opening statement on the government in the Sunshine Act.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Hall will entertain a motion to close the meeting.
Thank you. We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
There is. I move to adopt the agenda as published.
I second the motion. The motion has been made and seconded. Is there any further discussion? If not, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
The agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
I second the motion. The motion has been made and seconded. Is there any further discussion? If not, the secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. If you will, please turn to tab 1. And the next item on the agenda is the approval of the minutes as presented behind tab 1.
I move to approve the minutes for the September 11th, 2025 regular board meeting as presented.
Second the motion. Motion has been made and seconded. Is there any further discussion? If not, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. At this time, I'll ask Shara Pollard of ORP to present the update on Farm Credit System funding conditions. This will be an information item.
Good morning, Chairman Hall and Board Member Smith and everybody else present. For those who don't know, my name is Shara Pollard. I'm a senior policy analyst with the Finance and Capital Markets team in the Office of Regulatory Policy. Part of our responsibility is to approve system funding requests, and adjacent to that function is monitoring of funding conditions and board reporting. So with that, I'll move on to my prepared remarks. Next slide, please. Next slide, please. So I wanted to start off just covering a few recent financial headlines that relate to funding conditions. The first is the Fed's rate cut last month. They cut rates by 25 basis points. This was largely due to weaknesses in the labor market, but I'll talk about that in a little more detail in an upcoming slide. Next slide, please. Something else that's been in the news is the M2 money supply. So M2 is just, it's a broad measure of the money supply. And it's been in the news recently because it's surpassed its prior peak, which was right after the COVID pandemic when a lot of liquidity was being injected into the economy. It's not necessarily something to be concerned about in terms of its inflationary impact. There's a lot that kind of goes into that measure, but it is something that we're monitoring because it can impact inflation, and it's something that the Fed looks at as they work through their rate decisions. To the extent that the M2 money supply does have an impact on inflation and puts upward pressure on treasury yields, that could impact farm credit system yields and push those higher. So it's something that we're monitoring. Next slide, please. So the U.S. national debt, it's at 37 trillion. I think a more useful way to think about this is the debt to GDP ratio. And we're right around 120%. And the risk here is that if that ratio continues to grow, investors could be hesitant to purchase U.S. treasuries or demand higher yields. Farm credit system yields are linked to treasury yields, so we would see an increase if that were to materialize. We have seen some impact on our spreads from increased T-bill issuance recently, but I'll get into that a little bit later. Next slide, please. So these are the topics that I'm going to discuss. I'm going to start with just a brief overview of what's happening in the global markets, then look at agency debt, and then more specifically at farm credit system funding activity. I also want to talk a bit about yields and spreads, and then touch on secondary liquidity. And what I mean here is our banks hold investment portfolios for the purpose of liquidity. So if they don't have access to the markets to issue debt, they rely on their investment portfolios to be able to fund maturing obligations. And then I'll just talk briefly about some geopolitical impacts. Next slide, please. So in terms of the US market, we've talked about the Fed and them cutting rates. I think as most of you might be aware, they have a dual mandate, full employment and price stability. There has been some indication recently that the jobs market is weakening, slowdown in hiring and in job growth. These weaknesses, they haven't really flowed through to the unemployment rate yet. There has been a slight increase in unemployment. But part of the reason for that muted impact is the reduction in the supply of labor because of lower immigration. So we'll just see how that dynamic plays out in terms of the supply of labor. If that stabilizes but demand continues to decrease, you might see the unemployment rate increase, and that would support a future rate cut. Then on the inflation side, the Fed's target is 2%, and the metric that they use to measure inflation is 2.9%. So much of the recent pressure on inflation is coming from housing. There has been some impact from tariffs, but it's been somewhat less than people have anticipated. And part of that is because retailers have been passing those costs. They haven't been passing them through to their customers as of yet, but there are indications that might change. So the inflation picture is giving the Fed pause in their rate cut decisions. But the economy, it's fairly resilient. And part of that is due to declines in imports, but it's also due to a fairly strong consumer, as well as quite a bit in the way of CapEx spending on AI. So the median forecast for Fed officials as of right now is 2 more 25 basis point cuts through year end. But we'll see sort of how that plays out. And then in terms of what's happening elsewhere, the Eurozone economy, it's been somewhat sluggish in terms of economic growth, but inflation has started to ease. The ECB, they held rates steady at their last meeting, right around 2%, because they do still continue to have some inflation concerns. The Bank of England, it's somewhat similar. They are seeing modest improvements in their economic growth and falling inflation, but for different reasons, there are some internal inflationary pressures that are giving them pause. So they held rates steady at 4%, but they have been reducing rates. Japan, they're actually undergoing monetary tightening. So they've been hiking rates. They hiked them in January and then they kept them steady as they assess their economic outlook. China continues to face quite a few structural challenges, both internally and then externally, including impacts from the tariffs. Their central bank they have been reducing rates, but they left the rate unchanged, right around 3% at their last meeting. And this is partly due to the limited impact that prior cuts have had. So they're just pausing to sort of assess. And they're also trying to protect their currency. There has been some concern that China is going to start selling off U.S. Treasuries due to the political tensions. What we've seen in recent months is a continuing decline in Treasury holdings that really began during the Great Financial Crisis. So it's not clear that that trend is accelerating, but I think the key point is that the percentage of foreign holdings of U.S. Treasuries has remained fairly stable because we have other countries that are increasing their holdings, such as the UK. So we're not seeing material risks to the U.S. Treasury and GSE markets stemming from the monetary policies of these other countries, but it's something that we continue to monitor. And then in terms of geopolitical impacts, so these can come in the form of the military conflicts that we're seeing in the Middle East and Ukraine, trade wars, and now even cyber security attacks and infrastructure attacks from overseas. Beyond sort of the upside risk to inflation that can result from these conflicts, there's the risk to the stability of U.S. institutions that can come in the form of cyber attacks. So a lot to keep our eyes on. Next slide, please. I wanted to touch quickly on what's happening on the longer end of the yield curve. So this shows 10-year yields for the major economies. For the most part, we've seen a general increase in 10-year yield since our last presentation in May. This is despite the rate cuts that we've been talking about. I will clarify, the U.S. Treasury has sort of been range-bound for a while, but it's not coming down despite the rate cuts, and that's largely because investors have concerns over the ability of governments to sustain their high levels of debt. Next slide, please. So as a reminder, system debt ratings are linked to that of the U.S. government. The green highlights changes since our update in May. Moody's did downgrade U.S. debt from AAA to AA+, and this was largely due to concerns over the debt and fiscal management. This didn't have a material impact on the system's ability to access markets or on our spreads. It was largely anticipated, so it was something of a non-event, but something to note. And the other two rating agencies did reaffirm their ratings in August. Next slide, please. So this is a slide that we present every time that we give a funding update, and it's just a reminder of the issuance. We are second to the federal home loan banks in terms of issuance. The FHLBs, they have shorter term debt, so it turns over more, which is partly why their number is so much higher. We might slip to third place in 2025 as Fannie has been issuing more. Theirs again is more on the short term, so it's not necessarily a direct competitor to a lot of our issuance, but it is something to note. Next slide, please. And then just to quickly remind everyone of the size of the GSE market, we're just over $2 trillion. And the Farm Credit System, we're in second place, around 22% of that market. So our debt continues to be well received, given our mission, our GSE status, and the consistency of our financial results. Next slide, please. So this slide, it outlines Farm Credit System debt issuance from 2021 through 2025 as of August. The yellow represents discount notes, the purple is floating rate notes, and then the blue is fixed rate, non-callable, the green is callable. And sort of the big story here is starting in 2022, there was something of a rotation from discount notes into SOFR floating rate notes. So you'll see the yellow decline and the purple increase. And that was partly because of rates were moving up over that time period. So the SOFR floaters were more attractive. Investors generally prefer floating rate note in rising rate environments. And then our banks will either match fund SOFR floaters to floating rate assets, or they will swap the debt to fixed using derivatives. But part of what's been supporting the growth in SOFR floaters is just the huge amounts of money that have been flowing into money market funds. Part of that is due to higher rates, but it's also At least in 23 and 24, that inflow was due to investor uncertainty over the economy, so it was a flight to safety. And then there were some SEC regulatory reforms, which made government money market funds more attractive, and those are the funds that hold our debt. And then I'll just point out, so there has been an increase in callable debt issuance in recent months as rates have come down a little bit, which we'll talk about later. More debt has been called, and that has to be replaced. Next slide, please. And this is just the Farm Credit System debt outstanding. It sort of reinforces what I talked about on the prior slide. You see the floating rate note outstanding, the percentage as a total of debt increasing over the years, and that's in purple. Next slide, please. So our dealer group, these are the entities who underwrite our debt and distribute it. There haven't been any changes since our last presentation. There's still 34 dealers in the group. And our debt continues to be held by a broad group of investors, and that's partly due to the work and the capabilities of the dealers, as well as the funding corp managing those relationships. Next slide, please. So I talked about the Fed's rate cuts, and I wanted to just touch on the yield curve here. This is the yield curve for the Farm Credit System bullet debt as of the beginning of the year, and then as of our last funding update, and then the most recent time period. And so it's still inverted, and I know Dave talked about that in his last presentation, how that can be an indication that the market is expecting a recession or a slowing of economic growth. But you will see, and it also puts some pressure on financial institutions because they borrow on the short end and lend on the long end of the curve. But you will see it's come down a bit on the short end as the Fed cuts rates. And then that middle part of the curve, because that's come down, that's enabled our institutions to call debt and reissue it at more favorable pricing. Next slide, please. I wanted to touch quickly on spreads. So this is the spreads of our debt to treasuries. Our fixed rate notes, I mean, you can see there are the bottom two lines. That's the 2 and the 5 year where most of our issuance is. Those remain very low and stable. There was a little tick up during the Liberation Day, but they've since come down. Next slide, please. And then just looking at SOFR, floating rate note spreads, somewhat similar in the sense that during Liberation Day, we saw that increase, as well as during the regional banking crisis, spreads moved up. You will notice on the right side of the graph, spreads have moved up a little bit in recent months, and that relates to the issuance of the increase in T-bill issuance as the Treasury rebuilt its cash positions. That sort of crowded out our debt slightly, but the spreads have since stabilized. So that was, a brief move up, and they've since stabilized and are still relatively low historically. Next slide, please. As I mentioned earlier, our banks hold investment portfolios for the purpose of secondary liquidity. This just compares levels, total days liquidity as of March versus June. No material shifts, really. The blue is level 1 liquidity, so this is the highest quality of assets. And I think the main point here is that total days liquidity, as well as level 1, is well above regulatory minimums. So ample liquidity. Next slide, please. I wanted to touch on just a few wild cards that are on our radar as we move forward through the rest of the year and beyond. Fiscal policies, just seeing how that evolves given the impact that can have on investor appetite for U.S. treasuries, as well as the level of treasury yields. Trade policies and tariffs and how that sort of feeds through to inflation. And then the Federal Reserve, we're keeping an eye on, the rate forward, the path forward in terms of rate cuts. In terms of global conflicts, I mean, we touched on this a little bit. We have the actual military conflicts and trade wars. These can impact commodity prices and feed through to the farm economy. But in terms of capital markets, they can lead to just volatility, which can make it a little bit harder at times to access debt at competitive prices. Next slide, please. So just to kind of sum up, I want to reiterate that overall demand is very strong for system debt, especially for SOFR debt as of right now. The yield curve does continue to be inverted, but we're seeing that change slightly as the Fed starts to cut rates. Our risk premiums are still very favorable, despite a slight increase in SOFR premiums over the last couple months, and strong secondary liquidity. And then the wild cards, we touched on those on the prior slide, just again, something that we're going to continue to monitor. So with that, I'll conclude my remarks and see if there are any questions.
Thank you, Shar. Board Member Smith, questions?
Yes, Shar, it's great to see those spreads over treasuries continue at historically low levels. That means we're providing affordable financing to our farmers and ranchers. Because my question comes back to the rating agencies. It seems like the U.S. fiscal policy has more influence on the rating agencies than the farm sector. We've seen a lot of headlines on the stresses in ag right now and a price relief package in the opting. Do you hear any rumbling or questions about the farm economy on the part of the rating agencies?
Yeah, I have asked this question to the funding corp, and what we're hearing is that it's obviously something that investors and the dealer community are monitoring, but it hasn't been voiced as a concern at this point.
Okay. And of course, our confidence in the farm credit securities, our safety and soundness adds to that security then.
Yes.
Okay.
Yeah.
Thank you. Thank you, Mr. Chairman.
Yep. Thank you, Shar. First, appreciate your presentation. I have no questions.
Thank you.
Now, if you will, we're going to turn to Jason Moore of ORP to present the notice of proposed rulemaking, loan servicing, performance categories, and financial reporting. This will be an action item. Jason?
Good morning, Chairman Hall and Board Member Smith. My name is Jason Moore, Associate Director of the Operations, Management, and Accounting Team in the Office of Regulatory Policy. Before we start, I'd like to recognize Shrita Ola, Senior Policy Analyst in the Office of Regulatory Policy, and Laura McFarland, Senior Counsel in the Office of General Counsel for the contributions to this project. The matter before the board is where the FCA board should approve and issue a proposed rule that would amend the regulatory high-risk loan performance categories by removing formerly restructured loans, TDR, also known as troubled debt restructurings, in response to changes in generally accepted accounting principles commonly referred to as GAAP. At this time, I will provide a brief background on the Accounting Standards Update, ASU, that led to the proposed rule, as well as action FCA took in the interim to address the ASU. On March 31st, 2022, the Financial Accounting Standards Board, FASB, issued ASU number 2022-02, Financial Instruments, Credit Losses, Topic 326, Troubled Debt Restructurings and Vintage Disclosures, which, in part, eliminated TDR recognition and measurement guidance under GAAP. Entities that follow GAAP now evaluate these loans, which previously would have been TDRs, in a manner consistent with guidance for other loan modifications. In addition, ASU 2022-02 requires enhanced disclosures for certain loan modifications when a borrower is experiencing financial difficulty and introduce qualitative and quantitative disclosure requirements for loan modifications provided in the form of principal forgiveness, interest rate reductions, other than insignificant payment delays, or term extensions, or a combination thereof. ASU 2022-02 updates all entities that adopted ASU 2016-13, Financial Instruments, Credit Losses, Topic 326, Measurement of Credit Losses on Financial Instruments, and the Current Expected Credit Losses, CECL, methodology. The system adopted CECL on January 1st, 2023. To initially address the update to GAAP, on December 30th, 2022, FCA issued Informational Memorandum, Accounting Standards Updates on Troubled Debt Restructurings, to provide interim guidance to the system on the changes in GAAP related to TDRs. Specifically, the informational memorandum instructed system institutions to implement the change in GAAP and disclose modifications to borrowers experiencing financial difficulty beginning with the first quarter of the fiscal year 2023. I will now discuss the proposed rule changes as well as our solicitation for comments in the proposed rule preamble. Our proposed rule would revise the accounting and reporting regulations in Subpart C of 12 CFR Part 621 to incorporate a change in GAAP. Proposed rule would remove regulatory references to TDRs in 621.6b and make related conforming technical changes. Proposed rule preamble contains GAAP compliance information for placing the loan modification and vintage disclosures in quarterly and annual reports using existing regulatory provisions. Additionally, the proposed rule preamble informs system institutions to expect separate guidance on the relationship between GAAP's loan modification accounting instructions and system compliance with the distressed loan servicing provisions of the Farm Credit Act of 1971 as amended. The proposed rule does not contain additional proposed changes to the high-risk loan performance categories. However, system institutions requested FCA revisit these categories. In response, the proposed rule preamble solicits comments on whether FCA should retain the loans 90 days past due and still accruing interest category. Prior to presenting the proposed rule for FCA board consideration in compliance with Executive Order 14215, we submitted the proposed rule to the Office of Information and Regulatory Affairs, OIRA. OIRA, which is responsible for identifying regulatory actions subject to interagency review under EO 12866, determined that the proposed rule was not a significant regulatory action. The Office of Regulatory Policy expects this action to be considered a deregulatory action. This concludes my presentation. I'm happy to answer any questions you may have.
Thank you, Jason. Questions, Board Member Smith?
Yeah, I'm just kind of chuckling. The semantics of a proposed rule versus a deregulatory action, it's a little confusing, but I understand where we're going with that.
Yeah, I think key points, what he wrapped up with, it's considered a reduction in the regulatory burden for the system. And it's actually something we've reviewed for several years and finally able to move forward with. So I appreciate the work of Regulatory Policy Office and General Counsel's Office, everyone who works on it. So Jason, thank you for the presentation.
Yep.
At this time, I will ask you to provide a recommendation to the board.
Okay. Staff recommends the Farm Credit Administration Board approve the following resolution. The FCA board hereby approves the attached draft proposed rule, which would amend the categories for high-risk loans contained in 12 CFR 621.6 by removing troubled debt restructurings. The FCA board authorizes staff to make any technical or grammatical changes that may be necessary for publication in the Federal Register.
After receiving the staff's recommendation, is there a motion from the board on the recommendation?
There is, Mr. Chairman. I move to approve the staff's recommendation regarding the notice of proposed rulemaking, loan performance categories, and financial reporting.
I second the motion. Motion has been made and seconded. Is there any further discussion on the matter? If not, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hull?
Aye. Motion carries. Thank you, Jason.
Thank you.
If you will, please turn to the adjournment tab. If there's no further business to bring before the board, I will entertain a motion to adjourn this meeting.
I move that we adjourn the meeting.
Second the motion. Motion has been made and seconded. Is there any further discussion? If not, the secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hull?
Aye. Motion carries and the meeting is adjourned.